October Wealth Advisory Review, where we take a look at ideas and strategies to create, grow, protect, and preserve your family's wealth in today's economy and thinking forward into tomorrow as well. I look forward to talking with you tonight about several pieces. I know that from talking with you all during this last month, you had some questions, so hopefully tonight we'll be able to answer some of those for you. Let's do this here. There we go. As always, everything we talk about here, whether it has investment aspects to it, or it has tax aspects to it, or it has, excuse me, having some allergy problems here, whether it's looking at wills or trusts, estate design, etc., all of these pieces need to be considered carefully as you go forward. The types of investments, the types of tax strategies you might consider, the types of estate design, all of these should be involving multiple people, not just us, but also any other experts that you're working with. And as always, when we're looking at investment choices, we want to make sure that we choose the investments that match your income and growth needs, your risk tolerance, your liquidity, and cash reserve needs as well. So please, as always, think through carefully as you make choices. And if there's pieces that you're working with outside of what we do, please feel free to let us know, and we'll be happy to help bring whatever expertise we can to those discussions as well. As always, there'll be a time for questions. If you raise your hand or you chat a question during the middle of the presentation, I will take a look at it and see if we should answer it now, or might put it off to a little bit later in the program. But certainly at the end, we will have time for questions that you might have as a result of some of the information we'll discuss tonight. Tonight, we're going to take time to look at the market and economic review. We're going to take a look at getting ready for spring planning. I'm going to share with you my final thoughts, what I think happens as a result of the information we share tonight, remind you of some of the resources that are available to you, answer your questions, and then help you remind or make Nate save the date for the next advisory review. You know, I skipped September. I probably shouldn't have. I'm kind of a little rusty right now. So, but we will take time to remind you of the upcoming advisory review for November as well, and so you can put that on your calendar. So looking at the primary engines of economic growth, GDP growth is still positive. Business profitability is still positive. Unemployment rates are still positive, and interest rates are still positive depending upon which side of the equation you're on. If you are in a senior who's enjoying the increased rates of return on fixed investments, then it's a positive. If you're a business dealing with some of the extra expenses associated with that, it's not as much of a positive. But however, you notice back to business profitability, we did put a plus minus there because they are experiencing growth still. It may be muted, but it is still there. However, with the increase of the interest rates, of cost of fuel, of the increasing of the US dollar, those pieces are working against us, and part of the reason why I think many people are concerned about where the economy is headed and what we should do next. I would, as always, share with you that we've been waiting now 6 quarters for a recession. We review information almost daily from various partners we work with, and I would say right now about 1/3 of them are concerned about a recession, and the other 2/3 are not. Everybody says recession's possible, but only 1/3 of them are actually seriously looking at what's going to happen. I don't know that I would take that seriously as far as saying, well, okay, so 2/3 think it's not going to happen and 1/3 does. I don't know. I would say that I think the 2/3 that are saying it's they're not worried about it probably are being a little optimistic. I think it's realistic to assume that we're going to have some sort of a recession. I think whether or not it's going to be a soft landing, which is what the Fed would hope for, the Federal Reserve obviously trying for that soft landing, but in reality, about 40% of the time, they do have a hard landing. And simply put, that means that the length and the depth of the recession are what we're talking about. A soft landing would be a short recession, maybe a 1, 2, 3 quarters with a shallow decline in GDP growth. A deeper one would have a much either longer term or deeper fall and the GDP going negative in a much bigger way. Both of those pieces would have impact on the stock market, would have impact on the real estate market, would have impact on the bond market, etc. But having said that, we do not see it yet. It doesn't mean that we have our heads in the clouds and we're not looking for it. We are, just like you are, but we just haven't seen it yet. Certainly higher interest rates, higher cost for oil and gas, the tightening of the dollar. We also see that many people are not saving like they were before, which is also an indication that we could be headed for more challenging times. But again, if I show you the market here in a minute, you'll see that's not what is happening yet. Where did my, there we go. Let me take this and go to a live review of that chart so we can see actually what we're seeing, what's going on right now. So taking a look at this, you may notice, if you can see this, hopefully got your screens on full size. Going back to 2019, you can see where we were before. This would be in 2020, just before the pandemic hit. That's February. This would be where the pandemic sort of sank to its bottom and then how it came back. This was our most recent high back in December of 2021. 2022 was a tough year for market-wise. Market was down almost 19%. The S&P 500 that we're looking at here has come back up and then it started to drop again. Now, I'm showing you a wider view. We're going to tighten up for a second, but just to kind of point out, so this is the high pre-pandemic. So you can see that if you follow that line all the way across to the far side, to the far right, that we're still much higher than what it was even at the best before the pandemic. And if you take it down to the bottom of the pandemic, we're significantly higher. Yes, we did have a tough year. Here was the high point of 2021. Markets went down. We then hit this low here at the end of the year. You can see we're still higher than that, and then we came back. Now let's break this out and take a little tighter look on it. And again, taking a look at what the fundamental analytics, which I was talking about a moment ago, what various financial institutions are telling us, taking a look at that would say that it's about a 50-50 right now. Oh, no thanks. It's about a 50-50 right now on the idea of a possible recession. But again, as you can tell here, the high of 2021, we're still not there yet. But I think what's a little more interesting, from my viewpoint anyway, is what we see here when we come to this part right here where we are today. And this is where we are today. And if we follow this line across, what I want you to notice is how we have these ceilings of resistance and floors of support. Right here in July of 2021, that was a ceiling of resistance that if you go across to the right again, you will see that we are right at that same ceiling today. As you follow across here, here's a floor of support where the market held when it pulled back in October of 2021. You can see that again, it tested, broke through the floor, then came back up. Another ceiling of resistance, meaning that it went up but couldn't break through it. Come across over here. We had a little bit of a pullback right here, but again, back to sort of a floor of support where it couldn't break through. It took back off again, and then here's another floor of support. You'll notice that this whole place right here at about 4350 on the S&P 500 has been this demarcation where either the market has a resistance to going lower or it has a resistance to going higher. With that, you'll notice that as we're looking at the 50-day moving average, it's moving down and it's about to run into the current daily activity. You'll also note that the 200-day moving average, which it bounced off of here, is also moving in. So you can see that both are sort of tightening together. What that means is at some point here, we're going to either have a moving average convergence, divergence above or below. And that's sort of intuitively obvious. I don't want to make that sound dumb, but that really is what our choices are. I think it's going to depend greatly on what the fundamentals show over the next 30 to 60 days. And that will then give us some insight into whether or not this is going to then actually go back down again. It could, again, break through this floor of support again, could break through the 200-day moving average. But as you'll note here, there have been other times when it breaks through and comes back. So it's not by any means the end of the world. It's just part of the process of what we have to deal with. Having said that, we're not resting on our laurels. We are taking a diligent look, being proactive wherever possible, reactive whenever necessary to make adjustments in the portfolios. And I think for many of you on this call, we've been doing that with you. Some of it we've been doing automatically in your managed accounts, and others we've been talking about some options and taking advantage of some of those as we're moving forward here. If you have questions and we have not talked about that with you, please feel free to give a call to the office and we'll be happy to sit down and talk in more detail. And for our guests on the phone, if you have questions and would like, or on the webinar tonight, if you have questions and would like to get in more detail about your own personal situation, you can certainly give us a call here and I'll give you information at the end for that. Having said that, I would say that at this point in time, we are in October. October is historically a challenging month for the markets. We're also looking at a possible recession. How deep or shallow, how long or short it is something we're still waiting to digest. As we look at the data for going into 2024, it does seem to support that 2024 could be a better year, but I would also be the first to say that 2023 was not supposed to be doing as well as it has been doing. So when we look at data, we try to be, again, proactive wherever possible, reactive wherever necessary, and creating a risk model for your tolerance to make sure that you're meeting your income needs and growth needs, and it's matching your risk tolerance with the portfolio. And then again, flexibility or reserves are part of that process as well. So as I would say tonight, I'm not worried, but I am cautious. I'm optimistically cautious because of all the things that we do see, and even the reports we read that state that they do think recession is much more likely. Everybody agrees that there's a huge amount of cash out on the sidelines right now looking for places to go. The increased interest rates has helped with that. The market volatility when there were downturns has helped with that. Certainly real estate, there have been some options, some opportunities there as well. And then there has been, for those who are more concerned, there have been opportunities in the precious metals area, as well as energy recently. So as always, there are pluses and minuses. I see a fair amount of blue sky, but I also see some clouds out there that are looming ahead. Whether they're going to roll away or roll over us, we'll see. But at this point in time, I can tell you that I'm very optimistic and watching forward carefully what we do. But again, if you have particular questions for your situation, please do not hesitate. That's what we're here for, to answer those questions and to help you find confidence in what you're doing investment-wise and planning-wise, and to sort of demystify all of this information. It's a complex arena for the financial services industry. Our goal is to try to make it so we demystify everything for you to the best of our ability, and then to sweat the small stuff so you don't have to. So with that in mind, let me move back to my materials for tonight. There we go. So as always, I'm taking time here to remind you, and we're going to focus a bit on the planning side of this, what we call spring planning. I know this isn't the spring time, but if you've been watching how we do our webinars, we try to focus on planning at the beginning of the year, so we try to move everybody's thinking that way. As we move into the new part of the year, we start looking at having conversations about investments and insurance information, risk management, so that we're ready for the summertime to do that. And then finally, as we move into the fall for our planning clients, we're looking at how to minimize taxes, review estate design, make sure everything is on track for for where you need it or want it to be. But the three phases of your financial journey, as we've talked plenty of times before, and I'm going to run through a couple of these items. For those who've attended this material on a monthly basis, you'll see some things you've seen before. For the guests, this will be some new information for you. But as always, we're looking at the three phases of your financial journey, which first off starts with your accumulation phase. Starts in the 20s or the 30s and ends in the 50s or the 60s for some of you. Get to the top of the mountain, you plant that flag, you say, I'm out of here, color me gone. And then you move into the decumulation phase, 50s or 60s or 70s, depending upon how well you've set things up for yourself or your desires as far as when you want to retire or redirect. Then you move through the process here of decumulating, pulling money out of your accounts. We put a lot of information or a lot of focus on the sequence of return risk, because that can really damage a person's retirement planning process. And then for those who are older, we take a look at end of life risk, because again, most healthcare expenses are experienced in the last year of your life. And then finally, once you have passed away, we look at how to transfer assets to your loved ones, the people you care about, or the ministries or charities you care about, and try to disinherit the IRS in that process. So those are the three phases. All of us are going to go through them. Some of us will be different in our circle of wealth. Some of us have more, some of us have less. But as always, we want to make the most of whatever it is we have, and in that process to accomplish your desired return on life. As I've shared with you before, as we look towards spring planning, everybody here has the experience with planning, whether they have done it for short-term events like a shopping trip or some special event or a day trip or a short vacay or a long vacay. Everybody has done planning at some level. They set a destination and a date and time. They create the plan for getting from where they are to where they want to be. They identify the supplies and resources that they'll need. They identify the tools and or equipment they're going to need to do that. And in some cases, they might bring an advisor or a mentor into the discussion to make sure they get the best deal. And again, whether or not it's these shorter term issues or it's things like moving to a new city, moving to a new country, your personal journey throughout your entire life, or maybe just your retirement journey like we're talking tonight, or maybe it's your lifelong journey. You see, the fact is with your lifelong journey, this is your story. You're the hero of this story. We're just the mentors or the guides. We're Yoda to your Luke Skywalker. We're the person who's supposed to help you figure out what you need to do and to give you insight for that to accomplish what your goals are, both with your finances as facts and figures, as well as your return on life, the feelings and desires. And so that's why we try to put together material that can answer both sides of those issues for you. Our goal is to help you define the date and the time and destinations for these goals, to assist you in establishing a plan to achieve them, to help you identify the supplies, resources, tools, and equipment needed to accomplish those plans, and then to mentor or guide you along that journey to accomplish that plan. And with that, a lot of times I think the questions or the discussion moves to products. We had a first meeting today with a prospective new client, a guest is what we think of that person as. And they came, and again, a lot of the conversation started out initially talking about products. But while products are absolutely essential, the process is what we're more interested in focusing on. That doesn't mean that I don't understand the value of the products. I do, but the process is critical. I'm going to show you some things tonight to help explain that. But if I put it in simple terms, club versus swing. I don't know how many of you are golfers. I play at golf. I'm certainly not a good golfer, but I would say that if, for instance, you can think of a golfer you might know, but I think one most common to all of us would be Tiger Woods. Tiger Woods, I believe, come into your town, my town, go to a yard sale, buy a set of clubs that were decent, but just, in a yard sale, and probably go to the local golf course and whip everybody there. He could beat everybody with that yard sale set of golf clubs. That's because it's not the clubs that mattered, it's the swing. Tiger Woods has developed a process for a very good swing. The clubs can be good, but the swing and that process is what's essential. So with that, we're with you on your journey, not just for products, but even more importantly, in my opinion, for processes. So a question, if you were to say, and I understand some of you on this call, you are retired already, but if you were to think in terms of how well are you prepared either for retirement or prepared for the rest of your retirement on a scale of 1 to 10, 1 being that you don't feel prepared at all, 10 being that you feel fully prepared, where would you land on that scale? Would you be at 1, 2, or 3 because you're not sure how well you're prepared? Would you be at 8, 9, or 10 because you feel very confidently prepared? Hopefully you're not saying 7 because 7's sort of in that middle. It's what we all want to be, is 7, but our goal is to help you get to 8, 9, or 10. That's what we focus on, because we want to help you identify your journey and then help make that process come together for you. You know, I've shared with you before a financial quiz, a financial planning quiz I've used with people, and it's really appropriate for tonight's discussion. And I'll just go quickly with it or through it with you and then show you what I mean by how it fits so well with what we're talking about when it comes to your return on life, the facts and figures associated with your financial plan, your investments, your insurance, your risk management, etc. How you minimize taxes, fees, and expenses. So the quiz goes this way. Think percent sign, little rate of return sign right here. What rate of return do you have to make on your investments between now and the time you retire to be able to retire and stay retired? Do you know that answer? Most people, I can tell you, as I've done this quiz with many, many, many people, most people do not know that answer, what rate of return they have to achieve. So the second question, think dollar sign. How much do I have to invest monthly or annually between now and the time I retire to retire and stay retired? Many people I talk to do not know that answer either. How about work? How many years do I have to work between now and the time I retire so I can retire and stay retired? Many people I speak with don't know that answer either. And it's not, I assure you, it is not simply a money or amount of money question. A lot of people, even people that are what you might consider to be financially successful, don't really have the answers to these first three questions. Now, for those of you who are saying, Frank, I'm already retired, I don't have the answer to those questions, or I don't need the answer to those questions, the last question is for all of us then. Because if the plan we have in place with rate of return, dollar sign, and work is not going to work, then the question then becomes, if my current plan isn't working, I want you to think of the word lifestyle. If my current plan isn't working, how much do I need to reduce my retirement lifestyle to make it possible to retire and stay retired? And again, I find a lot of people don't actually know that answer either. And our goal is, when I say to demystify retirement planning, whether it's pre or accumulation planning or post decumulation planning, trying to demystify that to make sure that people have those answers in place. We provide a number of different resources to help clients do that. And our goal tonight is maybe to give you a little more insight into how that works. So using this tool that we use occasionally to kind of help bring about a better understanding of it, as we help you plan your journey, we're starting with some basic information: your current age, your retirement age, your life expectancy. And you might say, well, Frank, I'm going to live longer than 84. Okay, great. We just adjust that number. Maybe your retirement age isn't 65. Maybe yours is sooner. Maybe yours is later. Take a look at your current income. With the current income you have, the annual savings you have, what you plan to save annually, as well as the accumulated money you have. Those then go into a calculation as well. Then we take a look at the accumulation rate of return that you need to get as you're on the accumulation side of the mountain. Then the distribution or decumulation rate of return you need to get in order to make sure that you can make it safely down the mountain. Inflation, because we know it's going to cost a lot more to live in the future than it does today, just like it costs more today than it did 15, 20, 30 years ago. And then taxes, the IRS wants their portion. And so adding all of these figures together to try to figure out how long will the amount of money, our retirement nest egg, if you will, how long will it last? And then there's other items we can add into the calculations as well. Maybe you have some defined benefit plans. Maybe you have worked at a company that has a retirement plan for you. Maybe you have other resources that are going to come down the road, future assets that you might be thinking about. Maybe there's future expenses that you have ahead of you that we need to plan for. Or maybe there's a legacy desire. Maybe you want to make sure that your children have resources. Again, we talk with people all the time that say, I want them to receive something, and we work out what that number looks like. But those 4 items fit into this calculation as well. And then finally, current lifestyle. And in this example here, we put down, oh, if they're making 102,000, but they're living on 76.8, that's current income minus taxes, minus annual savings. So that extra portion is going to taxes and savings. We then use that as the basis for what they want in retirement. And that retirement lifestyle, we carry it forward because some people might say, well, I need more in retirement because I want to travel. And some people might say, well, I don't need as much in retirement because I'm not going to be doing all the stuff I'm doing now. And then adding this cost of living adjustment right here to it. So the reason I'm slowing this down this way is to help you recognize that when we talk about planning, as we move towards January and we start our spring planning with all of our planning clients, that there's a number of factors here: age, income, assets, if you're still currently saving, the rate of return you need to get on your money before you retire or once you retire, handling inflation, dealing with taxes, and then including all of the various resources, either incomes or outgoes, that are necessary to make it all work, and then blend that with your current lifestyle. So I'm showing you this really to simply say that it's a calculation, and these are the components of this calculation, and with some solid planning, some wise thinking, there's no reason why all of us couldn't have a better plan than what we have now if we don't already have a plan in place. And this is where I'd say that sentence, that planning to fail or failing to plan is planning to fail. And this is one of these tools that we use to help in the process, not just pick out products, but make sure that the products match what your processes require. So in this example here, and those numbers I just showed you, this is what those came out to. And in this example, you can see under the present projection that the person ran out of money at age 68. Now, that's based on these factors up here. Remember my 4 questions: rate of return, how much you're going to make or save, how long are you going to work, and what will you spend in retirement. You see, the fact is all of these are what they are. And knowing ahead of time which ones of these you need to change to make it work better for you is part of what this calculation looks like. Now, the last one, change inflation, I'm not going to change inflation because, quite honestly, inflation is what it is. We've just come through a pretty inflationary period of time. Maybe that's going to stop for a while. Hopefully that will continue to move in a downward trend. But realistically, as we look over the history of tracking inflation, it's been roughly about 3.5% per year. So that means some years were much higher, some years were much lower, but nonetheless, we have to count for inflation because it costs more to live today than it did 25 years ago. And if you're going to be on this planet for another 20 or 30 years, it's going to cost a lot more to live then than it does now. So now let me take you to a live calculation of this so you can kind of see how these numbers would work together. All right, let's go back here. And so there's that retirement ready or not that I was showing you. And here's that calculation, the page I was running off of before. We're going to actually take and examine in more detail how this might look. I'm going to keep the same numbers. I realize your numbers would be different. Everybody on this call or on this webinar, their numbers would be different, but that's okay. We're just going to use this as a way to sort of understand what this looks like. We'll save this for next month. But for now, this is that same result I just showed you a moment ago. So now, the reason I'm showing you this is because I talk with clients who, some of the younger clients, and I guess some of the senior clients as well, use software off of websites that can help them sort of calculate some of this, which is fine, but it's, as I was showing you, a little more complex than, quite honestly, a lot of these free websites work. And so I want to take a few moments here to show you. So this side over here is the present calculations for what we put in. This side over here is where we can revise these numbers and kind of create a better outcome. And just so you understand, I know we were talking about having that roughly $75,000 of lifestyle. I think it was probably closer to 80. This is that inflated number. If I click on this, you'll see it stays at that 76.8. And so consequently, when I add the inflation back to it, then you can see that's what we have to work with. So the first thing is I'm going to suggest that we put in something like Social Security so that we have Social Security in there to give us a better outcome. So the Social Security is in there, 45,000. Maybe you have more, maybe you have less. I'm treating this as a husband who's got 30,000 or and a spouse that's got 15,000 of Social Security benefits, a 1.5% cost of living adjustment starting at age 67 and running their full life, half of it being taxable based on this. Now, if you make more money than what we're showing here, it would be more taxable. But I'm going to put that in there, save that as part of the plan. And then we're going to start working on some of these numbers. So for instance, I could increase the rate of return. Now, I'm going to show you something that's interesting. If we try to focus on only one aspect, it really kind of blows everything up. So if I say, let's calculate the retired return, and we're going to continue with our age 84, and so we're going to calculate, and what it says is we need to be making almost 11% on our money. Now, that by doing so, you'll notice, so this column over here, you can see over here that this runs out to age 84. Now, you might say, Frank, I want to make sure I get past 84. That's fine. We can come back and adjust that. But you'll notice that by increasing our rate of return, we fixed the process. Instead of running out of our proceeds, our resources income account or investment accounts, I'm sorry, at age 68, we still have money here, and that continues on down. And it goes out to age 84. Now, again, I can change a number of things here, but for this one, I'm going to, instead of saying calculate it, I'm going to specify it. And instead, because 10.8 is just too unrealistic, let's just say it's 7%. We got a 7% return here. What does that do? Well, okay, so that only takes us out a year. That takes us out to 69. So we get another year on it because we're not that far from retirement. We're looking here just at a little bit of time. And so consequently, we want to make sure that we can get a rate of return that matches our risk tolerance. Maybe you're saying, Frank, I could handle more risk and 8% would be fine for me. Maybe you'd say I could handle less risk and I need to stay at 6%. Okay, fair enough. But I'm going to show you how not just using one of these, but using multiples of them can really change the outcome. So let's say that once you saw these numbers, you're like, oh my goodness, that's not enough. I don't want to plan for that. I want to plan ahead. So yes, I'm willing to invest a little more aggressively, but not much. But you know what? I can actually control my spending a bit. I can save more. And so, you know, in this example, we're dealing with both a husband and a wife. I'm going to specify an amount. And so since you could put away a lot more in retirement, I'm going to make this so we could put away, say, 7,000. I'm sorry, 14,000. Because we're going to say both spouses say, you know what, I'm going to make this happen. Whether they're putting it away through their 401k or they're putting it away through their IRA accounts, either way, this would make it so they could start to get closer towards that goal. And so if I calculate that, now you'll notice over here on the present projection, we get to age 68, but over here, we start to go farther. We get to age 75 now because we've saved some more money. Now you might say, well, okay, so that's still not enough. You know, I don't hate my job, or maybe I don't like my job, but I recognize I might have to work longer. Okay, fine. So then we'll identify, what if we were to work longer? What if we specify the age and say, well, I can get full Social Security at 67 or 68. So let's just put 68 in and see what that does. So if I put 68 in, we can see now I'm decided to work that long, and now my money goes to age 82. So at age 82, I still have some money. It gets me out there just a little bit further. 83, I'm basically living off of Social Security then. Well, then let's make one more adjustment. Let's say that, all right, it's not my big plan, but between all these other points, I can actually, you know, take a little bit less income. So instead of the 83,921, I'm going to say I can live on 75,000. And so if I say, well, I can live on 75,000 with inflation happening and so on, if I make that work, that thing gets me down to age 85. So you can see by making minor adjustments along the way, and maybe you say, well, Frank, one of those is not a minor adjustment to me. I want to retire at 65. Okay, great. Maybe what we could do is take a look at putting away a little bit more now. You might say, well, I can't do that, but I'm open to taking a little more risk. We could take a look at how that would fit. But again, I would encourage you that if you decide to take a little more risk, you want to get the reward, that you understand that risk. And we have tools on our website that can help you estimate that risk and what your risk tolerance is to make sure you're not too far outside the box. Or maybe you say, you know, I don't think I can reduce my lifestyle by a little over 10%. I just think that's too much. Then we can take a look at what you do there. But if you start to think about this for a minute, what you realize is all of these represent a mathematical equation to help you get from where you are to where you want to be. And that's really what this is all about. How do I accomplish the goals I want to get to the lifestyle I want to achieve, to have. And it's not a one size fits all. Everybody's situation is different. Some of you are more risk taker. Some of you are more risk avoider. Some of you can save more and some of you can't. Some of you can work longer and some of you say, I don't think I could do that. Even, and when I say work longer, it doesn't mean you have to stay at your existing job. Maybe you could choose a different job that would then make some money for you. Maybe it wouldn't be as good as your current salary, or maybe it'd be even better than your current earnings. I have a number of clients who have worked for big corporations, and when they retired, they went to consulting and they're now making more than they were before. So maybe that's what you'd say. Or maybe you say, I just can't do that. And maybe you say, well, I could live on less. I could make that work. All of these choices are part of your planning process. And that's what we start in January for all of our planning clients. You don't have to wait till January to get that started. If as you're reviewing this, you're thinking to yourself, I really do think I should start sooner rather than later. Great, then we can take a look at that sooner. But this is the process for helping people stay on track and even to be able to answer those 4 questions. What rate of return do I have to earn on my money? How much do I need to be saving or investing? How long do I have to work? And if my current plan isn't on track, what do I have to do with my future lifestyle to make it get on track? And that's how we pull this together. That's why this is a far more complex discussion than just simply saying, well, let's invest in, and you name the investment. This is about process, not so much product. But once you know the process, for instance, you say, well, okay, I want to take, I need to get a little more money on my money. That's going to move us towards one group of investments. Or maybe you say, well, I can save more and I want to do it in a tax advantaged way. Well, that moves us a different direction. Maybe you say I can work longer. That gives us a longer time frame. That also helps with some of these issues. And then maybe you say I can spend a little bit less, which means that we might be able to adjust some of the earnings later on. Because, and here's the important part. Let's go back here. So let's say you get to 65 or 66 or 67, and so you're like, well, I've got this amount. Or let's say you have 200,000 more than that because things have really worked out well for you. Well, that tells you that you're ahead of track. Or let's say you're 200,000 behind because the economy's been a little bit challenging and you weren't able to put away more. So you're like, I'm a little behind track. So that instead of pulling the trigger and retiring and hoping it all works out, you actually have a plan in place for accumulation, decumulation, and then transfer, if you want to transfer anything to family and friends and such. This is a simplified version of what the planning applications we provide to clients will do. This gives us a quick answer to a lot of questions, but it's, like I said, sort of a simplified version of that. And our goal is to help people to begin thinking through what they need, the facts and figures of their current situation, and the facts and figures that we need to be looking towards for their future situation, to be able to help them stay on track with that, and then know year by year, are they on track or are they off track? Are they ahead of track? And what could they do differently as a result of that? So let me put that down for a second and come back to this. So as you can see, when we're looking at these resources, trying to figure out the best answers, we start with your current facts and figures, and then we begin expanding out to the various issues that will help you achieve that goal. Again, not a one size fits all. The process is the process, and it's a way to help people get from where they are to where they want to be. And again, you're the hero of this story. We're just the guides or the mentors in the process to help you accomplish what you need to do, or to at least get you closer to where you need to be. And that's why we use these kinds of programs and software applications to help our clients figure that out and move forward as we help them measure their financial journey. But as I've said a couple of times, it's not just about defining and identifying and measuring. It's also about enjoying your journey, because we help you enjoy your journey as well. We call it retirementality. Retirementality is identifying how to get that return on life balance that you're looking for. What are you doing and what do you want to do? So you and I, all of us have 168 hours in the week. And if you run down this particular application, it helps you identify how much time do you spend at work, how much time do you spend sleeping, how much time do you get to spend with family and friends, how much time do you get for downtime, for health and fitness, and for personal growth. For all of us, the total down here is 168 hours, and you get to break out the percent of time. But I was just visiting with somebody over the weekend, and we were talking about how as he's looking to retirement, he's a little anxious. He doesn't quite know how he's going to retire, what he's going to do in retirement. His wife told him that he can't sit around and watch TV all day. So he's trying to figure out some various things. And my encouragement to him and to all of us is to start thinking about, well, what would I like for it to look like? If this is 40 hours a week and I don't have to do this anymore, then what do I do with these 40 hours a week when it comes to family and friends or downtime or health and fitness or personal growth? How do I redesign and achieve that desired lifetime portfolio that I'm looking for? And then not only in the hours itself, but in the activities, in those activities, in retirement-mentality, envisioning your return on life. What are the things you want to do? Travel, play, write, educate yourself, go back to school, teach, mentor someone, learn new skills, finish unfinished projects you've been working on, more time with your spouse or family or friends, start a new business, continue on your present course with education or career or whatever, consult, as I mentioned earlier, get a part-time job, connect with some cause you believe in or volunteer, get involved in community or take on a new challenge. The fact is those hours that you are currently giving to your profession, vocation, career, those can now be moved to other things that you want to do. Some of those might be a career that you've been wanting to do. They might work for pay. Some of the things you might do might be working for service. But whatever the case, knowing the feelings and desires and blending them wisely with the facts and figures of your situation is critical to helping make each step of the process up and down the mountain work well for you. Our goal is not just to identify and help you enjoy it, but to help you review the journey. Because the reality is, as you look at those areas, family, health, work, retirement, financial, and giving goals, our goal is to be able to look backwards and say, well, when you were 57, we started this process, and as we moved through the years, we got different things accomplished. We achieved goals that you wanted to achieve. Not that we achieved them, you did. We just helped mentor or guide in that process so that as you go from 57 to 67 to 77 and on, that you actually have a plan in place and you can look backwards and see how that's been accomplished. We break those up into life goals, your bucket list, things that you'd like to accomplish before you take your last few breaths of air on this planet, and life transitions, things that you may be forced to deal with, say during the next 12 to 24 months. And having a plan in place, because again, we're all faced with challenges that we may or may not have expected, but having a process in place for how to deal with those transitions makes our planning work better, both short-term, mid-term, as well as long-term. And then having those bucket list items as mile markers of things we'd like to accomplish. As part of your planning process, we have applications you can use to help us stay on track with that, to give you tools to make that work better for you, and to accomplish those goals that you want to accomplish. So we want to be able to look backwards over time and review your journey to make sure that we actually accomplished what you were trying to accomplish. Now, when I talk about creating, growing, protecting, and preserving wealth, using a well-defined direction and an intentional approach for this whole measuring process, looking at process and products and how those fit together, this takes us to that part. So we start out with your return on life financial plan. And I've been sort of illustrating or giving you some understanding of how these calculations work. Because again, I see commercials for people at other firms that say, we're fiduciaries. Okay, great, fiduciary. But they're fiduciaries on one side, the investment side. But in reality, I think that there's more to that investment side to understand somebody. A fiduciary means that I'm thinking like you think. Now, I'm much more of a risk taker than some of you. And some of you are more risk taker than I am. And so to be that fiduciary isn't just simply filling out a questionnaire and saying, okay, well, this is how much risk versus reward I can take. It's about understanding the transitions you're facing, the bucket list items you want, how you want to handle the accumulation phase, the decumulation phase, and the transfer phase. That then makes it easier through this process. And that's really important. The bottom of the triangle, the base of it, is the process for how you calculate it out. Then you choose products, investments, as well as insurance that will help you then think that process through. And how we handle investments is, as you've seen before, We take a look at the different products that suit your needs. Cash reserve for flexibility, liquidity, easy access. Bonds that are more income oriented, designed to meet your income needs. Equities or stocks, which are more designed to meet your growth needs. Real estate, which is kind of like a different version of equities, but instead of being stocks of companies, it's real estate where the companies reside or their employees live. Another growth asset. Tangible assets, things like metals, energy, commodities. Those types of assets can be built into your portfolio. Currency, the US dollar, I mentioned before, it's been strengthening. And there have been plenty of times when we've used that as one of the investment tools. Business interests, which you'll notice are right across from equities, whereas equities represent about 10,000 different companies that you and I can invest in the country and in some cases around the world. Business interests are private or alternative equity kind of programs that you can't invest in publicly. They have other restrictions. They have gain opportunities, but they also have liquidity or risk provisions attached to them. And so they're not for everybody. As a matter of fact, many of them require you to have a net worth of $1 million or more, not including your house. And so you have to sort of qualify for some of those types of programs, but they can add to your portfolio mixture. And then finally, insurance and annuity programs, which can then be used to help mimic some of these other versions, whether it's bonds or equities, real estate, whatever. But it also gives you stabilizers or protections against loss of capital or income. And those pieces can help make your portfolio so it has more surety and less probability for those who are more risk avoider. But for those who aren't, maybe those products are not the right solutions, because everything on this list, all 8 of these circles, has pluses and minuses, pros and cons to them. And understanding which ones work best for you is also part of that fiduciary thinking to identify what your goals are, how that fits with your investment mixture, and how that fits with your return on life financial plan. And then finally, the third quadrant is your personalized risk management solutions, using certain types of insurance products in some cases, certain types of trusts in other cases, depending if you own a business, maybe certain types of corporate ownership, various pieces that can be all tied together to make it so that your foundational return on life financial plan is meshing well with your investment and risk management strategies, creating, growing, protecting, and preserving wealth. And these are the processes that we use to help clients go from where they are to where they want to be and have as comfortable a journey along the way as they can. There's all kinds of bumps in the road. You've seen that for the last few years if you've been watching carefully, or maybe not even carefully. And there'll be more bumps in the road, but having a good plan in place makes it easier to handle that process along the way. The wealth advisory and planning tools that we provide for our clients who are using the planning resources, a financial dashboard that is 24/7, 365 with all of their information, their income and their outgo, what they own and what they owe. A report suite available for all the reporting needs they might have. They're going to get a loan at the bank, or they're trying to get information together for their accountant. An electronic vault that is a electronic version, an e-vault, to store your important documents in. You may have a safe at your house that you put your important documents in, or maybe a vault or a safety deposit box at the bank. But if you want access to something 24/7, 365, the electronic vault lets you store it in there. It's all bank grade encryption. You can access your documents, and God forbid something happened to your house and you couldn't get to your box with the information, you could go online and print them from your vault. Planning reviews every 4 months. The first, and I've referenced it a couple of times tonight, the first 4 months of the year, we focus on spring planning. The second 4 months of the year, we focus on investment and insurance reviews, past and going forward. And then the last 4 months of the year, we focus on estate review, estate design review for looking at beneficiaries and the costs associated with your estate, as well as tax reduction strategies, both current year and future years as well. That's what the beneficiary estate design and income tax review below it is identified as. The annual risk management assessment for your insurance programs, things that we either help you with or things we have nothing to do with. Same's true with your investment strategies. We have assets that we help clients with, and then some assets they can't move to our management yet, and so that's part of that as well. And then finally, the return on life review, updating your transitional and life goals as part of the planning process. These are the tools, or at least some of the tools we use to help you understand where you are, where you're going, so you can answer those 4 questions, percent sign, dollar sign, work, and lifestyle, to know that you're on track for meeting your goals. These are the 4 portals to the website. So if you go to our main website, then you go right up here where it says login, it brings you to this page, which is where you will find your financial dashboard that blends with the various pieces of our planning process, your portfolio dashboard, which are assets that we use to help you manage your money so you can see how that's fitted. Now, this is showing everything, but it really doesn't do a good job reporting returns. This, for the assets we're managing for you, this is what that's about. Also, we have a risk and reward evaluation program that helps us understand on a scale of 1 to 99, 99 being the most aggressive, 1 being the least aggressive, where your portfolio, your risk tolerance is at, and then we can then compare that to all of your investments, both with us and outside of us, to say, how are you doing with that? Are you matching your risk tolerance, or are you under or above your risk modeling? And then finally, a lot of the ROL items, the life, the bucket for life, goodness gracious, your life goals, your bucket list, there you go, your bucket list, and then your transitional goals, because you know as well as I do, you might be sitting there looking at a parent who's going to need extra care in the next couple of years, or maybe a spouse or a child. You might be looking at going back to school, and you're going to plan to do that in the next 12 to 24 months. All of these various pieces, and there's 63 different life transitions that we work with. Every one of them has financial implications, even though many of them aren't financial in nature, but they're impacting the family's finances. And so we use this software, this last one, your financial life plan, to tie the feelings and desires along with the facts and figures of the rest of your financial journey. So my thoughts for tonight really kind of come to this. 1, our goal is to continue to monitor economic and market conditions due to recessionary concerns. That hasn't really changed in the last 12, almost 15 months now. We've been anticipating something. It hasn't really happened yet. When inflation was so high, I was certain it was coming, but it didn't. When we saw gas prices go up, I was certain that would be a real indicator for this. It hasn't been. As we've looked at money supplies, both personal and corporate, thought that was going to be an indicator. It hasn't been. And so there's various pieces that we watch. And so rather than putting our head in the sand and making no decisions, we actually are systematically taking a look at ways to be proactive whenever possible and reactive if it becomes necessary. And that's what we do with our managed portfolios. So we'll continue to watch all this for you and sweat the small stuff so you don't have to. But as always, if you want to talk, we're here for you to review that. Any of you, anytime, that's what we're here for. Additionally, we want to practice the processes of intelligent planning to help demystify your financial future, to make it so you feel comfortable you're on track for what you need to do. We want to, in that process, make sure we're looking at accumulation rates, distribution rates, inflation rates, tax rates, to make sure that all of your planning is real and relevant. We want to take and make it so that it's even more specific to you, looking at defined benefit plans you have, future assets you have, expenses, and a desired legacy for those of you who want to leave something for the next generation to improve the accuracy of your financial life journey calculations. Return on life, I have to tell you, I love the numbers, the facts, and the figures, but truthfully, it's the desires and feelings that probably make what I do the most enjoyable for me. I was at an event for one of my clients just recently. A lot of his high school friends were there, and I got to visit with a number of people. And you know, I love meeting people. I love working with people. I love helping people. And while it's great to talk about the facts and the figures and the outcomes, the calculations, the truth is when they say, you know what, we're taking this trip that we've been planning for, that excites me. When they say they're going to buy this vehicle they've been planning for the last 2 years, that I find pleasure in. And so helping people achieve their return on life is probably what motivates me the most in this process. Yes, products are essential, but processes, in my opinion, are the difference between clubs versus swing. Helping people to accomplish the goals that they have is what this is really all about. Because when we take our last few breaths of air on this planet, none of us are going to be sitting there thinking, oh, I have $10 million or whatever that number is. We're going to be thinking about what did I do with what I had? And that to me is what ROL is all about. And then final thought there is fiduciary wealth advisor requires a dynamic financial planning strategy to help people manage their family wealth wisely in today's complex economic environment. And so again, all these processes, as well as many other things I didn't even begin to cover today, which I'll probably talk more about in the next advisory review with you. But these are all part of the process of helping people get from where they are to where they want to be. So now, this is a place where we have questions. I don't see any questions right now, but if you have questions, I'd be more than happy to answer those for you. If you want to either raise your hand or go to the chat box and type in a question, it'll pop up and show me that, and I'll be happy to go over that with you. Since I don't see anything, I'm going to move past her right now, but I'd be more than happy to come back in a second. We have been changing a little bit of how we're handling some things, and one of the things that we're going to do is going forward, we're going to do the monthly wealth advisor review on the second Tuesday of the month. It'll stay at 5:30 just like it's been, but we're going to move it to the second Tuesday instead of the third Tuesday. That way, there are certain holidays that would make it harder to hit if we stayed in that third Tuesday. I mean, you take November coming up, it's going to be hard for anybody to join us on the Thanksgiving week. So November 14th, 5:30, we'll be back here updating the information, sharing strategies for creating, growing, protecting your family wealth, market, fundamental and technical analysis, economic analysis, planning, investment, insurance solutions, and answers to your financial questions. Again, I would say that our goal with this is to identify economic and market conditions, because I know that's top of mind for most of you. Some of the things like taxes and planning and other things, they feel more secondary, but I would like to encourage you to think that the process is more important than the product, and we will continue to do both well. Having said that, if something unique or catastrophic or challenging happens between now and November 14th, we will have a quick update meeting. So let's say 2 weeks from now, God forbid, something terrible happens and we need to get on here, we will be sending out something ahead of time. So we will never leave you in the lurch on what's going on. But assuming everything continues along the same course, November 14th at 5:30 is when I would plan to do the next update. Of course, if I get to see you before then, that'd be awesome too. So now, in going through everything, what we've done is we've done the market and economic review. Hopefully, you might be thinking a little more towards getting ready for spring planning. Went over my final thoughts with you. I reminded you of some of the resources that we have available. There's more than what's on that website, but those are the 4 big ones we try to help every client utilize because we think they're essential to what you're trying to do. Didn't have to answer any questions. I don't see any coming up yet. Either that means I have totally confused you, or I've answered every question you have. And then I reminded you of the next advisory review. And if you have questions, please do not hesitate. You're not going to bother me or embarrass me at all. That's what we're here for. Last thing is this. We have different times where clients ask if their friends can attend. All of your friends are welcome to attend this. All you have to do is just let us know so we can send an invite to them. We set several invites out for this event to guests of our clients and friends. And if you have somebody in mind who you'd like to be able to attend this information, attend this webinar, and get the information we're covering, if they're your friends, we're more than honored to help you with that. So please, you can do that by emailing Kayla@franksoffice.com, and that way we'll get it, and then she'll follow up, or Melissa will follow up and get that information so they can join us for the next webinar. Back up there a second, there we go. So that brings me to the end of tonight's program. I hope, I got to tell you, I enjoyed sharing this with you. This really is part of what excites me about what I do and makes me get up every day and enjoy doing it for our clients, for you, for our friends, etc. I hope you got something out of this that was valuable and helpful to you when it comes to managing your family wealth wisely. And from that information today, I hope that really can give you some confidence as we go forward. If you have questions on it, want to get back together and talk individually, as always, we'll do that. You can just call the office at 386-248-2121. So now as I get ready to close it down, I'm going to go get some dinner. This coming week is bike week here in Daytona Beach, so I'm going to plan to do some bike week activities. I'm looking forward to that, and hope you have some great plans this weekend as well. And again, I don't see any questions, so I'm going to go ahead and say have a fantastic week. God bless, and I look forward to talking to you soon. And if you have any questions, please do not hesitate. We're always here for you. Thank you, and have a wonderful, fantastic week. Bye-bye.